Hi, this is James Shug with Westpac London's end of day report for Thursday, April the 12th. It was very much a risk-on day today with comments from the Fed Vice Chair, Janet Yellen, last night, augmented by comments by New York Fed President Bill Dudley today, making it pretty clear that the Fed won't be, or the FOMC won't be changing the language in its statement at the next meeting, April 24-25. It's in less than 2 weeks' time. I mean, Janet Yellen said that she thought that the highly accommodative stance was appropriate in the present circumstances. Bill Dudley said that he hadn't seen any set of information that would cause him to change the view that current policy settings were the appropriate ones. So, with the two effective deputies to Bernanke basically endorsing the current policy stance and language of the FOMC committee's statements over the last couple of years, i.e. that rates will remain low for an extended period and now extended out to 2014, it seems that the recent softening of the data and also perhaps some market jitters related to some comments that were pulled out of the minutes to the last meeting, which showed that some members were itching to pull back a bit on that language. It seems that there's been a concerted effort by those two to send a clear signal that the Fed ain't budging from its current stance. Janet Yellen also said that she didn't regard the end of the current Operation Switch that's going on, that started last year and it runs out in June. She wouldn't see the end of that program, which effectively lengthens the maturity of the Fed's balance sheet, as representing a policy tightening. But there is a bit of a debate about that. On the data front today, in the US, we had initial jobless claims, a measure of the extent to which workers are being laid off. The latest weekly number was up 13,000 to 380,000. The previous week was revised higher. So claims were significantly higher than had been expected. Remember that it wasn't so long ago that they were running at around 350,000 a month, although that's all been revised away now too. So it looks like we've now got 3 labour market indicators in the last week. Payrolls last Friday, NFIB Small Business Intention to Hire survey this week, and now claims, all pointing to the same thing. That is that the labour market hasn't sustained the strength that it looked like it was showing up until February or so. So also on the data front, we had trade figures from around the world, with the US trade deficit narrowing by $6.5 billion. Exports were basically flat, up 0.1%, but there was a broad-based 2.7% drop in imports, which could be a sign of weaker demand in the US, given that imports, of course, are a reflection of spending. In Canada, the trade surplus narrowed to 0.3 billion Canadian dollars, reflecting weakness on the export side, down 4%. Imports were about flat there. And in the UK, we saw a wider trade deficit there, came in at 8.8 billion, up from 7.9. Remember, of course, 60% of UK exports going to Europe, which is probably recessed at the moment. The other piece of data in the US was the PPI, producer prices, which were flat on the headline measure, but up 0.3, a little bit higher than the trend perhaps, mainly related to higher auto prices. But look, it really was the comments from the Fed, those Fed officials, that drove markets today. The markets are more confident that the Fed is going to stick with the current policy stance. That's fueled equity markets, it's fueled commodity markets, and it's fueled sort of other risk assets, including the Aussie dollar. And I'll run through the numbers in a minute. One thing on Europe, we did have industrial production figures released for the first month since August last year. In February, we saw a rise in European industrial production of 0.5%, although it looks to be related to localised very cold weather conditions, which boosted energy output, and which will probably be reversed subsequently. So it may be that that little glimmer of hope for the European industrial sector is going to prove pretty fleeting. The annual pace of decline in industrial production is 1.8%. That's the weakest it's been yet in the last couple of years, and it's below the pace that it was running, i.e. weaker than the pace it was running in the first 2 quarters of the recession in Europe back in 2008. So that's another indicator that Europe could already be in recession. We had 1 quarter of negative GDP growth in the fourth quarter of last year, and we're still awaiting the first quarter figures. So that's it in terms of data. Oh, Italian bond auction didn't go off too well today, reflecting those concerns that have re-emerged in the last week about Spain and Italy's ability to sustain and their debt levels and to keep financing their budget deficits. So a little reminder that Europe is still with us. Okay, in terms of market movements then, at the close we've got the FTSE in London up 1.3%, the French market up 1%, the German market's up 1% as well, the Italian's up 1.2%, but Spain actually down 0.75%, the only European market not to record a gain today. The Dow at the lunch break in New York is up 1.1% at 12,947. In commodity markets, as I mentioned earlier, they've done pretty well. We've got gold prices up 0.9% at $1,675 an ounce. Oil's up 1.2%. We're looking at $104 a barrel there, and copper prices are up at 2.5%. We're looking at 373 cents a pound for copper. The second highest, best performing commodity today, silver up 2.8%, posted the biggest gain of the 29 or so I'm looking at. Now, Aussie dollar, it's at 1.044 against the US dollar. It rose on the back of the strong jobs numbers that came out in Australia last night, and it's risen further, reflecting this bullish mood in commodity and equity markets as the risk on trade comes back, for the time being at least. The next big thing to watch for will be Chinese GDP data. A few rumours about it today. It's expected to slow from the rather strong looking 8.9% annual pace or annualised pace recorded in the previous figures to, well, on our forecast 8.2, on the market's forecast 8.4, but there were some rumours around today that pushed markets here and there, but better wait till the figures really until we make a final judgment on how China's performing. Okay, I'll leave it there for now, and back tomorrow.